Good afternoon or good morning. Welcome to another Crypto Winter podcast series interview. My name is Peter Renton, Chairman and co-founder of Fintech Nexus, and today delighted to be joined by Matthew Merle from blockchain Coinvestors. We are going to have a great conversation digging into the crypto winter. Before we do, though, just a quick announcement. We have our merge event coming up in London in October. We're bringing together the fintech community, the banking community, and the crypto community, all so we can all learn from each other. So that's happening in October. Anyway, with that, let's get right into it. How are you doing, Matthew?
Very well indeed. Thank you very much.
All right, so maybe let's just give the viewers and listeners a little bit of background about blockchain co-investors. You've been doing this a long time, it seems. So tell us a little bit about what you've been up to the last decade or so.
Yeah, thanks, Peter, for asking. So we have been blockchain investors for about 10 years. Today, we are one of the leading investment platforms focused entirely on blockchain. We're a specialist. We have the leading fund of funds in the world, which means we're investors in about 45 blockchain VCs, North America, Europe, and Asia, probably more than anyone else as far as we know. And then we have a couple of direct funds. We have an early stage token fund and a mid-stage growth fund. So all of our investing is early and mid-stage private investments in blockchain and crypto. So we're not traders. We don't invest in public liquid investments. We don't use leverage. We don't do staking and yield management. We don't do any of that stuff that we're going to talk about on this call. We are strictly early stage venture investors.
Right. So then maybe you could get, I went to your website and saw some of the companies in your portfolio. You've got some pretty big names in crypto that you've invested in already. So maybe can you share just a few of the names that you've invested in?
Well, we count ourselves as very lucky and very fortunate. We are actually investors in 60% of all of the blockchain unicorns.
Wow.
Through the VCs we backed. So I just want to be clear on that. We give all of the credits to the entrepreneurs and the folks that write code and make these projects a reality. And then in our case, the VCs that we back are the ones that back those entrepreneurs. But yes, we have capital in about 60% of the 93 blockchain enterprise unicorns and about 50% of the crypto projects that are trading $1 billion and up. And in those cases, we typically were in the formation seed or first private round.
Right. Okay. So the great thing about having you on this in this interview is that you've been in this space a long time before it was popular, and you've seen these ups and downs that the industry has gone through over the last decade. So maybe we could just get started by, I'd love to get your perspective on how you kind of feel like this downturn is similar and is different to previous downturns.
Yes. Thanks for asking. And let me say also, we've been in Silicon Valley, Alice and I, for 35 years. So here in the Valley, we've seen a lot of innovation and venture booms and busts and cycles. Right. And across all different areas of innovation, enterprise technology, life sciences, clean energy, and so on and so on. So what we tend to find is that, well, firstly, I think you should make a distinction between public traded assets v venture. So in the conventional world, if you will, you might start off investing in Google in its seed round or its formation round. There'll be a Series A, a Series B, a Series C. Eventually, it will IPO. It will become a public traded equity. And the whole world can, at that point, invest in Google. But we make a distinction, private v public. So everything up to the IPO, it's private. After that, it's public. And we look at the markets and how they trade as very different. So for us as venture investors, we're long-term, illiquid investors in equity and tokens in blockchain. But there's a whole different world, which is the traders, and they are traders, the traders in public liquid assets And that could be equities, it could be fixed income, it could be foreign exchange, and it can be crypto tokens. So this particular crash is primarily in the crypto, in the public liquid crypto tokens, but it is also in public equities, and it is also in public tech stocks. So Amazon, Google, and others are down significantly too. So we've seen a broad downturn in the public markets, but we feel like it's still a great time in the early stage private markets.
Right.
And I emphasize that point because we've had other crypto winters where really you couldn't get anything funded in the early stage. And I don't think that's true today. I think that what we're really seeing is the dramatic decline of a lot of the public liquid traded tokens.
Right. Because it seems like, I mean, you read over the last few months that, you know, some of the biggest venture capital names in the world have raised new, sometimes billions of dollars dedicated to investing in early stage crypto companies. So clearly there's a lot of dry powder there that is left to be, left to be invested. So it seems like that's one of the differences, right? Because they're good. If you have a good company, maybe in 2018, it was going to be hard to get funded after the downturn kind of really got going. But now it feels like to me that there's still going to be money flowing in because that money is just sitting there, right?
Right, I'm agreeing with you, Peter. But if we look at the dot-com boom and bust, the internet, which was TCP/IP and everything built upon it, really began to get a lot of momentum by the end of the 90s. And obviously, you and I remember the launch of all sorts of dot-coms in the 90s. Yep. We also, in that period, obviously saw the launch of things like Amazon and others.
And Google.
Then we had this, and then we clearly had irrational exuberance, and late stage valuations went absolutely crazy. And we all knew that. Early stage valuations tend to go up less, so perhaps they go up 2 or 3x, but late stage valuations might be going up 5 and 10x and more. And then we had the crash. And the crash began with the late stage valuations. All of a sudden, people lost confidence. You couldn't get those deals done. You couldn't IPO those companies anymore. The IPO window closed. And it did ripple back to early stage, but not by very much. And in retrospect, that was a great time for early stage investors. State Street's done some very good analysis, which demonstrates that early stage funds raised and invested in the 2 years following a downturn outperform by a substantial margin. And so going back to your point, there is a lot of dry powder. And for funds that have been raised recently and are mostly not yet invested, I think now is a great time because innovation doesn't stop. Right. The good entrepreneurs don't stop. When we have a downturn like this, what happens is a lot of marginal players abandon the space. A lot of would-be entrepreneurs go and get jobs. But the really, really serious blockchain enthusiasts and Web3 enthusiasts will still go about their projects. They'll still get stuff done. And just like in 2008 and 9, we tend to forget, but Coinbase and Uber and people like that, they got founded in 2009 and 10.
Right.
So we're long-term investors. We're looking at the 5, 7, 10-year time frame. And now's a great time, we think, to be continuing to form great blockchain-based opportunities and projects.
So is that the silver lining, or is, like you hear about, you listen to some of the podcasts out there that talk about this time and say, right, now's the time for building. Is there a silver lining for the downturn? And if so, what is it in your perspective?
It's a great question. For investors, the silver lining is low valuations.
Right.
The good opportunities in venture are very skewed. So the best investors tend to invest in the best opportunities, and a small percentage of startups do very, very well, and more than 50 or 60% fail. So it's a very skewed investment environment, early stage venture. And so the silver lining right now is for those of us who sort of stick to our knitting and carry on doing what early stage investors are supposed to do, the silver lining is low valuations. For the entrepreneurs, well, it's hard to say there's too many silver linings. It is going to be harder. It's harder to get people's attention. It's harder to raise capital. It's harder to get large companies, if you need large companies to work with, to get them involved. And the reason is that unfortunately some sort of ill-disciplined actors in the public markets have created a great big black eye for crypto, and it's going to take us a while to work out of that big black eye. And we can talk more about that in a moment. So a long answer to your question, Peter, but I think it's downturns are never easy for anyone. But the good thing is innovation never stops. And in fact, going back to the dot-com boom, you think about it, some of the most valuable companies in the world didn't even get founded until after 2001 and after 2009 for that matter.
Right. No, very true. Interesting. Okay, so let's just get into the a lot of the challenges in just in recent weeks, and we obviously saw the Celsius news came out yesterday, going into bankruptcy. We've had other of these centralized crypto platforms, particularly in the lending space, that have really struggled, whereas the DeFi platforms have not necessarily struggled as much. And do you feel like, from your perspective, is this sort of been a validation moment for DeFi and a black eye for the centralized platforms?
Yes, but with a caveat.
Okay.
I think it's very worthwhile making that distinction. In finance, in banking, an awful lot of effort goes into trying to assess counterparty risk. And, you can try and get a mortgage on a house just to make it, something everyone can appreciate and understand. The bank is going to do a lot of work to try and figure out who are you and are you good for the money? And furthermore, they're going to do an awful lot of work on the house and try and figure out, is this house worth the investment? Because if you do stumble, and if you do, they do have to foreclose on you, they're going to own the house. So they do put a lot of leverage on those investments. So leverage comes with investing, but risk assessment and understanding counterparty risk is absolutely critical in all lending markets. Mm-hmm. And unfortunately, what we just had was some very large centralized crypto players made very big bets with a lot of leverage, and they didn't analyze the counterparty risk. Mm-hmm. And Alice and I have said for some years now that we personally would not be staking our own Bitcoin or other tokens into one of these environments to earn a yield if there was a risk of 100% capital loss, because we don't believe counterparty risk is understood in fast-moving, innovation-based spaces. And crypto clearly is one of those. So that's the central banker, the centralized, the CeFi part of the equation. Very big, $10 billion, $100 billion players moving enormous amounts of capital, borrowing themselves, lending it out, and not really understanding counterparty risk. And unfortunately, that has all crashed down. Now, DeFi doesn't have that issue, because DeFi, the contract, the technology, sort of assigns collateral to the counterparty, and the collateral is held in the contract. And so if the counterparty fails, the collateral hopefully gets returned to the other half of the contract. So it is sort of a different equation. The issue in DeFi has more to do with bugs and hacks. Right. These are new technology platforms, and we all know all software runs the risk of bugs and backdoors and other issues. And we need to validate and verify that the technology works. And for most of the DeFi platforms, they've done a great job, but we have had issues in DeFi too. We've had some hacks, we've had some bugs, we've had a few other issues. Yep. So I think DeFi is looking pretty good in this particular downturn, but that doesn't mean it is ready for scaling up without a lot of additional, development and code validation and other things. So it's not completely a good news story for DeFi.
Right. No, that makes sense. That makes sense to me. So for those people watching live, if you have a question for Matthew, you can hit the Q&A button. We'll try and get to it before the end. So I want to talk about when you look out at the whole landscape now and looking at the different things that are being built, what do you think is really, what are you excited about? What do you think are the
Right.
not necessarily the company specifically, but the types of products that are most exciting?
Right. So great question, Peter. I'm going to answer that with our investment thesis, which is the following. It's taken us 50 years to digitalize the world's communications and content. And we did that with TCP/IP and the internet. And I know, every industry, every business, all of us, our lives have been transformed and changed. We can't have a global digital economy unless we also have digital commerce. And right now, most commerce is not yet digitalized. It's still paper-based. That's a shocking fact. But even though a lot of monies appear to be digital, they're sort of version 1 digital money. But by the time you get to assets, they're almost all paper-based. Real estate assets, funds, private investments, they're all still actually paper-based. So the digitalization of finance, of monies, commodities, and assets, and of commerce is absolutely inevitable. And blockchain plays a key part in that transformation. Now, blockchain is more than just commerce, but blockchain happens to be very good at transactions. And just like you and I communicate, we're sharing content right now, well, we also transact. We all transact all the time. And so the world's transactions are being digitalized. And that's true whether it's a money like Bitcoin, whether it's a store of value like Bitcoin, or whether it's an NFT, which is, a digital ownership certificate for an asset. And so having said that, Peter, we're not changing our investment thesis just because this month, last month, next month, the public markets are in crisis, because we're taking a 5, 7, 10-year view. And over that time frame, everything I just said is inevitable. And so the companies and the projects that are building out the world's new commerce platforms, accessible, low cost, fast, high throughput, high capacity, easy to use, those are the winning platforms in the future of all of the world's transactions, both the financial transactions, but obviously there's a lot of transactions that are not actually financial that can also be digitalized. Right. And so that's my answer to your question. So we could talk about layer 1 protocols, layer 2 middleware. We could talk about NFTs, digital exchanges, wallets. I think they're all part of the future and they're all very investable. It doesn't mean that every investment will win and succeed. Obviously, there'll be winners and losers, but we're not changing our investment thesis at all.
Interesting. Okay. So then what about banks and the banking system that obviously is, you mentioned earlier that some of the the larger companies sort of are looking at this and thinking, well, crypto is really not ready for prime time. And when you're talking to people, leaders at some of the crypto companies, and also maybe even talking to bankers, where has this crypto winter put them sort of the movement of banks, the interest that banks have in Web3, has it set that back, or do you feel like those people are the people that were engaged are still engaged?
Both.
Okay.
So so I think the banking and the payments industries globally appreciate probably more than ever that they're not doing a very good job today. And they've known for a long time that international remittances are too slow and too expensive. They've known for 40 and 50 years that it's not okay that just buying a piece of real estate takes 60 days, reams of paper, and the buyer and seller will between them lose 10% of the transaction in intermediary costs. They know that, right? And they know that you give them their money and they pay you nothing. And on the other side, they make money on your money, and that the spread is inefficiency. The reason they can't pay you an interest rate is they're too inefficient. They know that. So I think that the world's leading financial CEOs of banks and insurance companies and asset managers and payment companies understand they have to upgrade their technology. They know that their technology is not fit for purpose in a digital world. They are very well aware of all the hacks and breaches that they experience all the time. And the government knows they're not fit for purpose because they constantly have to give billion-dollar, fines all over the place for failures of compliance and KYC and everything in the established banking industry. Huge amounts of fines. So I think they all know they need to change, they need to upgrade. I think they were very interested and are very interested in Bitcoin and digital assets and monies as a potential piece of the answer, but without question, some people who didn't stick to the best practices of technology and innovation have just created a black eye that have probably set us back a year or two.
Right.
Because if you think about it, Peter, if you were the CEO of a big bank, and if you were really, really pro this new area of technology, now every board meeting, you're going to be on the defensive.
Yep.
Right? Are you going to be like 3 hours? Are we going to face a Celsius? Are you sure we're not going to have a lunar terror on our hands, right? So now you're on your back foot. And that means every meeting in every board room is going to be more difficult if this topic comes up. And so, yes, I'm sure it set us back.
Right. And one thing I want to just touch on is the user experience for DeFi is still, I mean, there are some companies that are really trying to provide a front end, but I'd just love to get your perspective of how much you think that is holding the industry back. I know when I've gone to, I went down the rabbit hole about a year ago where I got my MetaMask wallet and went and did a whole bunch of investments and learned a lot and, burned a lot of gas, lost a lot of money in gas fees as I was learning. But I'm curious from your perspective, do you think the user experience is something that's really holding this whole industry back or not?
Yeah, well, so with all technology, there's an adoption curve. And just to keep it really simple, maybe 10% of the people in most areas of innovation and technology are willing to be first movers or pioneers. Then you've got roughly 40% who are early adopters, 40% who are late adopters, and a tail end group of people who are laggards. And we tend to see that type of an adoption curve on most technologies. Mm-hmm. The early adopters, the pioneers and the first movers in crypto, look, there's 8 billion people in the world. So if you took 10%, that should be 800 million. Well, it's not 800 million.
Right.
We've got maybe 100 or 200 million users of Bitcoin and Ethereum and other things in the whole world. So we're still very much in that early phase. And many of those pioneers are very technologically savvy. So something that's really, really easy for them is very, very hard for most of the people in the world. Right. I remember in 2013 or 2012, I think it was 2013, Alison came to me and said, can we get some Bitcoin? And I literally tried to log on to, I think it was Dharma or DARPA or something, and don't remember the name, but I couldn't figure it out. It was too complicated for me. And I feel like I'm fairly technologically savvy, but I missed an opportunity. We would have bought a bunch more Bitcoin early on. We ended up using BTC at the time, because it was easy. We knew that it was more costly, but it was easy. And I know a lot of people listening to this will be throwing things at the screen right now and saying, hey, Matthew, you don't own Bitcoin in your own name. Well, unfortunately not, because for me, it's a bit complicated. And I'm also worried about hacks and scams and other things. So now think about that adoption curve, right? We now need to figure out how to get this technology to the next 4 billion people.
Right.
And those 4 billion people are not going to be able to figure out all of the things that the pioneers find it very easy. And if you look to China, I think you can see it a little bit more easily, because what Alipay and WePay did really, really well is their mobile apps are actually very easy to use.
Right.
And they are much more sophisticated than Western apps. Those apps combine Coinbase, PayPal, TD Ameritrade, your banking mobile app, your insurance app, all into one. And it's actually very easy to use. So yes, again, a very long answer, but DeFi, as well as crypto more broadly defined, is still on a journey to make things easy. And the easier it gets, the faster we'll accelerate the adoption of the rest of the world.
Right. Understood. Okay, so maybe let's close with this question. In a couple of years' time, we look back at this period. How do you think we're going to view it? What do you think the lessons learned are going to be? Are we going to take from this crypto winter?
Right. So my bet is, if we go out into the future, a lot of people will kick themselves because they didn't carry on investing through the downturn. If you go back to 2008 and 9, if you go back to 2000, 2001, if you go back to 92, the big lesson was that you should buy in the downturn. All right. So I actually think Warren Buffett says this quite well. And in fact, the Intelligent Investor on Wall Street Journal says it quite well. If you collect socks, Peter, and you've got a drawer full of socks and you love socks, if I tell you all the socks are half price, what should you do?
Right.
And the answer is, you don't sell the socks in your drawer, you buy more socks, you load up on socks. Actually, Warren Buffett talks about burgers in the same way. Well, that is the big point. The theory of investing is buy low, sell high. It's never buy high, sell low, or buy high, sell high, right? It's all about buying low. So right now is a moment when valuations and prices have collapsed. And when we're in the future and we look back, we'll all say, oh, I wish I had bought A, B, and C when it was X, Y, and Z price. And I believe that. And I can even look back. So I bought Apple and Amazon shortly after the downturn, and they're probably the best public equities investments I ever made. And I look back and I say, oh my gosh, I wish I'd loaded up on more of them. But the good news was Alice and I bought some of them. That is the big lesson. So there are other things, more tactical things, Peter. Make sure you understand counterparty risk before you give lots and lots of your money to other people. And conversely, don't lend to people who haven't gauged counterparty risk if they're in the business of trading and staking and other things. That would be a big one. Read carefully the small print in protocols and make sure they don't have fatal flaws built in them would be another. But I actually think the big so what in 5 years' time will be everyone that's saying, I wish I had loaded up on assets when the market prices were so low.
Right. Well, that's a good place to end it on, Matthew. Really appreciate you coming on today, and loved hearing your insights. And let's stay in touch. Thanks again.
Thank you very much, Peter.